We're starting off with a look at two companies that have been making headlines recently: Boston Beer Company and Alphabet, the parent company of Google. Boston Beer Company, the maker of Samuel Adams beer, has been facing challenges in recent years due to declining sales and increased competition in the craft beer market. Despite these challenges, the company has been working to turn things around through internal production gains and productivity initiatives, which have helped drive structural gross margin recovery. On the other hand, Alphabet has been investing heavily in artificial intelligence, with its Google subsidiary making significant strides in the field. The company's AI technology has been used in a variety of applications, from virtual assistants like Google Assistant to self-driving cars. This investment in AI has helped drive growth for the company and has positioned it as a leader in the tech industry. But what does this mean for investors? Should you be looking to add Boston Beer Company or Alphabet to your portfolio? To answer that question, let's take a closer look at the numbers. Boston Beer Company stock has been volatile in recent years, with the company facing challenges from declining sales and increased competition. However, the company's efforts to turn things around through internal production gains and productivity initiatives have helped drive structural gross margin recovery. Alphabet, on the other hand, has seen significant growth in recent years due to its investment in artificial intelligence. The company's AI technology has been used in a variety of applications, from virtual assistants like Google Assistant to self-driving cars. This investment in AI has helped drive growth for the company and has positioned it as a leader in the tech industry. So, what is the verdict? Should you be investing in Boston Beer Company or Alphabet? The answer depends on your individual financial goals and risk tolerance. If you're looking for a company with a strong track record of growth and a solid position in the tech industry, then Alphabet may be the better choice. However, if you're looking for a company with a rich history and a commitment to quality, then Boston Beer Company may be worth considering. We'll be right back with more from the world of stocks and finance on the Riskwiser Zone. Welcome back to the Riskwiser Zone. We are glad you are still with us as we dive into our middle segment. First, let's talk about Sterlite Technologies, an Indian multinational company that specializes in optical fiber and telecommunications technology. The company has reported impressive growth, driven by increasing demand for high-speed data transmission and the expansion of 5G networks worldwide. With a strong order book and strategic partnerships, Sterlite is poised to continue its upward trajectory. On the other hand, we have Dr. Lal PathLabs, one of India's leading diagnostic chains. The company has posted strong Q1 results, beating earnings estimates and delivering over 15% growth. This is largely attributed to network expansion, price hikes in certain schemes, and a robust balance sheet that could unlock inorganic growth opportunities. Brokerages such as Nomura, Nuvama, and JM Financial have all raised their target prices for Dr. Lal PathLabs, citing its market leadership, healthy cash generation, and revival of structural growth in the industry. It's essential to note that while these developments are promising, investors should exercise caution and consider multiple factors before making any decisions. The market can be unpredictable, and external factors such as regulatory changes or global economic trends can impact these companies' performance. As always, we recommend a balanced approach and thorough research before investing in any stock. Moving forward, it will be interesting to see how these companies navigate the complexities of their respective industries and respond to emerging challenges. For now, it's clear that Sterlite Technologies and Dr. Lal PathLabs are making significant strides in their domains. Welcome back to the Riskwiser Zone. We've got one final segment for you today, where we dive into the world of finance and explore some interesting developments. If you're considering investing or saving, you might want to pay attention to the current state of CD rates. According to recent reports, today's CD rates are still hovering well above the national average, with the highest rate being 4.20% APY offered by Sallie Mae on its 2-year CD. Now, it's essential to note that the Federal Reserve reduced its target interest rate 3 times in 2025 and has left rates alone in 2026, which has had a ripple effect on deposit account rates. This makes now a great opportunity to lock in today's high rates with a certificate of deposit. However, it's crucial to shop around, consider online banks, and review account terms and conditions before making any decisions. We've also seen some experts weigh in on where CD rates are headed in 2026, with some predicting that rates might go up or down depending on various economic factors. Ultimately, whether a certificate of deposit is a good investment for you depends on your individual timeline and goals. As we wrap up today's episode, remember to always do your research, evaluate your options carefully, and consider seeking professional advice before making any investment decisions. That's all for today's Riskwiser Zone. Remember to like, share, and subscribe, and until next time, keep your finances in check.